That headline number is a pretty...
it's a shocker.
It's a shocker.
It's a shocker.
When I saw that number, I went,
ooh, what happened here? Why? What do we miss? What did economists miss?
All right, let's talk about it here. Negative 92. I was going to do the numbers, Julia. Okay, negative 92,000. So the U.S. economy lost 92,000 non-farm payroll jobs in the month of February. That is a massive surprise compared to the 55,000 jobs that were expected to be added to the economy last month. The unemployment rate goes up by 0.1% to 4.4%. That's up from 4.3% the prior month. Average hourly earnings up 0.4% month on month, 3.8% over last year. Both of those beat forecasts by 0.1%. But the headline here is the headline: 92,000 non-farm payroll jobs taken out of the economy in February, a massive surprise relative to the 55,000 that we were expecting to add. Last month's job gains revised to 126,000, so basically unchanged there. So we're now, what's my math here, Julie? We're up 30,000 jobs roughly for the year, which is right on pace with the number of jobs we added on average in 2025.
That headline number is a pretty...
it's a shocker.
It's a shocker.
It's a shocker. It's the biggest negative number I can remember, I think, since the pandemic.
Yeah, it is interesting that you have that average hourly earnings number ticking up a little bit. 0.4% was the gain there. I mean, if all you're watching is that unemployment rate, it going up 0.1% to 4.4% is not necessarily good news.
Lauren, I'll go to you first. Just initial reactions on the numbers, and I think just a surprise that we all kind of couldn't believe. We've got down almost 100,000 jobs.
Yeah, I hope my microphone was off, because when I saw that number, I went, ooh. Look, the market leading up to this number today was really hoping that this was going to be a nothing burger, and I think anticipating that whether a little weak or a little strong, that's what it would be. This is a challenging figure, and with a market that's been digesting risks related to stagflation, higher energy prices and inflation risk related to the war in Iran, certainly concerns about where the labor market might be going with respect to AI and the economic cycle. This is only going to reinforce those positions, and I see the 10-year yield already falling, suggesting to me that the concern that actually the economy is on weaker footing than we all thought just a few minutes ago is the price action of the day.
I'm also struck by the fact that I don't think anybody had a estimate even near this low. I think I saw 35,000 was one of the lower end I saw. So, when you get a number like this, what happened here? Why? What do we miss? What did economists miss? What did we think was not accounted for?
Yeah, part of it, I think you have to dig into the details. Certainly when you think about construction, for example, weather's going to be a factor there. We did have some snowstorms that would weigh on things like residential as well as non-residential construction. I say non-residential because that's where you're really seeing a lot of the AI activity, if you will. On top of that, one thing we've been highlighting a lot, and I think something that needs to become more appreciated moving forward, is when you think about demographics in the U.S., retirements are a big story. We had record retirements last year in 2025 to the tune of 2 million workers. When you have workers retire, that subtracts from payrolls. So if you don't have that backfill hiring, that means you're going to start to see these numbers in terms of the payroll tick down.
I just want to give some of the details here. We were talking about healthcare before. There was a big Kaiser strike. Kaiser Permanente had a big strike, and that was expected to have an effect. So here's the effect that we had. Healthcare employment was down by 28,000. Physicians' offices down 37,000, and that was where the strike activity seemed to be concentrated. Hospitals added 12,000 jobs. So, that's something where obviously the strike is, well, I don't know about obviously, but the strike activity might not last.
It appears to have been.
Yeah, right. So we'll see if that lasts another month. Employment and information was down by 11,000. It's off by 5,000 jobs on average over the past year. Federal government employment was down by 10,000. So those were some of the places where we saw declines. Transportation and warehousing was down as well. So, there were a number of areas where you saw those declines, but the real pivot was that healthcare, which had been propping everything up, did not.
Well, I think, and coming back to, let's say, like the overall architecture of the labor market and getting a handle on it, Michael, in your note ahead of this report, you guys noted that this incorporates new annual adjustments to the household survey. Also, it made me think about, where are you and your team at in terms of trying to guesstimate or, estimate what that kind of break-even level of employment gain is in the economy? How much has that come down? How much do these adjustments impact that? Because, again, my second thought after seeing the headline numbers that if you put January, February side by side, we're right back at that 15,000 job number we saw last year. Is that what you're thinking about for the steady state employment number, or is that even a little below that?
That's about where we thought it would be for 2026.
Okay.
In 2025, we thought it was around 40,000 jobs per month to hold that unemployment rate steady. Following the QCW benchmark revisions for payrolls, that brought it down a little bit for us. So moving forward here in 2026, we do think it's close to flat to around 20,000 per month. And that factors in, again, the pace of retirements staying quite strong, as well as immigration, which has slowed notably. So without those two supply side factors really contributing to job growth, you have to get used to a new normal where you're going to see very little job creation. And that's not to say that there's not hiring underneath the surface.
Right.
I think it's a misnomer to say there's no hiring.
So, okay, so how do you figure out what's demand and what's supply, Lauren, when you look at these numbers? I mean, not just this number, but in aggregate and what we might see the rest of the year.
Yeah, so I think the way that we think about this question is really to try and separate what might be cyclical factors related to, how is economic growth doing right now, which, the situation in Iran still unfolding. A lot of the leading indicators were suggesting that actually the economic cycle was doing very well, if not picking back up. The Chicago Business Barometer for February, just in the last couple of days, really showing actually a positive impulse for hiring, and separate those from the structural issues, changes in immigration policy, disruptions related to AI. These are really difficult things to estimate and to parse out. I think the Anthropic report that we all probably took a peek through this morning is a good example of how even data providers and economists are trying to adapt their models for these changes in supply and demand. So the answer to your question is we try to reset our expectations, the way Michael's so elegantly putting out around what a good job number really looks like. I think even with lower expectations around the break-even job rate, this is a disappointing number, especially with the unemployment rate going up.